11. Recommending an insurance policy. Chapter 10 Assessing the client's situation provided a general overview of the issues or needs that should be considered when doing a life insurance needs analysis. This chapter explains how to quantify those needs and recommend an appropriate type and amount of life insurance coverage for a specific client situation. The concepts will be illustrated by continuing with Derek and Becky's family case study, which was introduced in the previous chapter. 11.1 Evaluate the probability, severity, and duration of risks. When doing any type of insurance needs analysis, whether it be for life, disability, or critical illness insurance, it is important to first assess the probability, severity, and duration of the risk, and ensure that the client understands what this means for them. This information can be summarized in a risk assessment matrix or table, such as the one shown in Table 11.1. Table 11.1, Risk Assessment Matrix. Medical or dental expenses high-low. Each person will have a different risk matrix, and it will evolve over time. For example, a healthy 30-year-old male with a young family would have a low risk of death, but the financial impact of his death on the family would be high. In contrast, an 85-year-old single female with no dependents would have a high risk of death, but the financial impact of her death would be low. 1.1.1 Probability of death. Most people avoid contemplating their own mortality, and prefer to assume that they are going to live well into old age. The agent should be able to convey the fact that the client's risk of death, although it may be slight at the current time, is still very real and needs to be addressed. The life agent should be able to explain that an individual's risk of death is based on a number of factors. 1.1.1.1 Current age and gender. The first factors are the individual's age and gender. Chapter 1 Introduction to Life Insurance module provided some statistics about average Canadian life expectancy and probability of death for both males and females. These same statistics are provided in a slightly different way in Table 11.2, which expresses the odds that a male or female of specific age will die during the year. This table clearly shows that the odds of dying increase with age for both males and females. However, aside from old age, females have lower odds of dying than their male counterparts. Females have lower odds of dying than their male counterparts. Table 11.2, Odds of dying for males and females 39. Odds of dying before next birthday are 1 in 8. Age male female 10 12,500 14,200 and 86 20. Sometimes expressing the probability of death in terms of odds helps a client visualize how real the risk of death is. Odds are simply calculated by dividing 1 by the probability of death. For example, according to the general statistics for all Canadians, a man who just turned 30 has a probability of dying before his next birthday of 0.104%. To many people, that seems to be a very low number. However, when expressed as odds, this means that 1 out of every 962 men who have just turned 30 years old will die before their 31st birthday. If the life agent can compare this number to something relevant to the client, example, the number of students in the local high school, or the number of people working for his employer, or the number of seats at the local hockey rink, it can emphasize how real the risk of dying is. Another approach is to present the probability of death occurring before a certain age, such as age 65. Based on the data set from Statistics Canada that was used to produce Table 11.2, i.e., an average for all Canadian males, the probability of a male who just turned 30 years of age dying before reaching age 65 is about 12%, which represents odds of about 1 in 8. The life agent in this situation can ask his 30-year-old client to envision 8 friends of similar age, and then point out that the odds are that one of that group will die before age 65. 1.1.1.2 Personal and family health history. Another important contributing factor to the risk of death is that person's personal and family health history. If the person has a history of health problems, or if his ascendant relatives have experienced diseases or conditions that carry a genetic component, then his probability of death is likely higher than the average Canadian. 1.1.1.3 Lifestyle risks. A person's lifestyle choices can also influence his probability of death, such as black small square smoking, black small square having a stressful job, black small square drinking excessively, black small square a history of driving infractions, black small square frequent travel, particularly to developing countries, black small square engaging in hazardous activities or hobbies. If the life agent learns that the client is exposed to these or other lifestyle risks, he can advise the client that his odds of dying are likely higher than the average Canadian. 1.1.2 Financial impacts of death. The agent should help the client understand what his death will mean for his family from a financial standpoint. The biggest financial impacts typically relate to black small square the loss of income, if the life insured is employed and supports his family, black small square the cost of replacing a caregiver, if the life insured is the primary caregiver of the family's children, black small square the need to repay debts, including a mortgage or a personal loan, black small square income taxes that result from the deemed disposition of capital property at death. The sections Insurance Needs Analysis, Income Replacement Approach, and Capital Needs Approach will explain how these financial impacts can be addressed with life insurance. 1.1.3 Duration of risk. The life agent also needs to determine how long the client's risk of death will be a concern from a financial standpoint. Obviously, the risk of death will continue right up until the actual time of death, but the financial impacts associated with that death may only present a problem for a short or specific period of time. 1.1. For other risks. The agent should consider other risks to which the client may be exposed, other than the risk of death, particularly those that could be covered under a life insurance rider, or that could interfere with the ability to pay the policy premiums. 1.1. Risk of illness or disability. The risk of becoming disabled for a period of 3 months or longer is significantly higher than the risk of death for all age groups. Disability can have as great an impact on family finances as death, if the disabled person is no longer able to earn an income. If the client does not have adequate disability coverage or a sizable emergency fund, he may be interested in adding a waiver of premium benefit or a dread disease rider to his life insurance policy. These may help him keep the policy in force if he becomes ill and is unable to earn an income. 1.1.2 Risk of unemployment. As noted in Chapter 10 Assessing the Client's Situation, the agent should try to ascertain the stability of the client's income to ensure that he will have adequate cash flow to pay the required premiums. If his income fluctuates from year to year, he may benefit from a universal life (UL) policy that provides some flexibility in the policy's deposits. 11.2 Insurance Needs Analysis, Income Replacement Approach. From an insurance perspective, income replacement approach is reflected by the loss of employment income that would result from the death of an income earner. This approach strives to replace that lost income, and it assumes that as long as this income can be replaced, the surviving family will not experience a reduction in their standard of living. Where the life insured provides an essential but unpaid function, his contribution can be expressed in terms of what it would cost to replace that essential service, or income in kind. 1.2.1 Capitalization of lost income. Under the income replacement approach, the insurance need is determined by calculating the amount of capital that would have to be invested to generate the lost income, as follows. Capitalized value equals annual income divided by rate of return. Case study: Derek currently takes home $8,400 per month. Assuming a rate of return of 5%, the capitalized value of his lost income would be $2,016,000, calculated as $2,016,000 equals $8,400 per month times 12 months, divided by 5%. This suggests that he should have about $2 million in life insurance. The life insurance need calculated using this approach tends to be high, because it assumes that the principal itself, i.e., the death benefit, always remains intact. Preserving the capital in this manner is also sometimes referred to as capital retention. Only the income generated by investing the death benefit is used by the beneficiary. This ensures that the income stream can be replicated in perpetuity, regardless of how long the surviving family lives. 1.2.2 Impact of investment returns, inflation, and income tax. The approach described so far is quite simplistic. First, it assumes that return earned on the invested death benefit will remain constant over time. To protect against changing investment returns, a conservative interest rate should be used, such as that available on guaranteed investment certificates or other term deposits. In addition, the approach so far fails to consider the impact of income taxes or inflation on income. Such additional refinements can be made as discussed below. 1.1.2.2.1 Accounting for income taxes. While life insurance proceeds are not taxable when received, if the proceeds are invested, the resulting investment income is taxable. When using an income replacement approach, lost income may be expressed either as a gross salary or an after-tax amount, and the capitalization of income should be calculated on the same basis. This means that if the lost income is expressed as an after-tax amount, the interest rate used when calculating the capitalization of income should also be an after-tax amount, using an appropriate tax rate. If the amount of income is small, relative to the recipient's other sources of income, the marginal rate tax rate should be used. However, if the amount is large, as is often the case when trying to replace lost employment income, an effective or average tax rate should be used. 1.1.2.2.2 Accounting for inflation. The model also assumes that the income being replaced would be fixed over time, when in reality an individual's employment income usually increases over time, at least at a rate to keep pace with inflation. Significant difference. This can be addressed by using an inflation-adjusted rate of return when calculating the capitalized value. The inflation-adjusted rate of return is calculated as follows. Inflation-adjusted rate of return equals 1 plus return, 1 plus inflation rate. Life Insurance Chapter 11 Recommending an Insurance Policy 234. In reality, the amount of capital needed will be affected by both income taxes and inflation. To account for both factors, the after-tax, after-inflation rate of return should be used, which is calculated as follows. 1.1.2.3 Weaknesses of the income replacement approach. The income replacement approach has the benefit of simplicity, but it fails to address what the survivors actually need, as well as how long the lost income would have been generated if the life insured had not died. Replacing 100% of lost income in perpetuity may be much more than the surviving family needs for day-to-day living, or it may not be enough. The income replacement approach also fails to address the life insured's desire to create or protect an estate. 11.3 Insurance Needs Analysis Capital Needs Approach. It is usually more beneficial to take a capital needs approach, which identifies all of the income and capital needs arising as a result of death, and converts them to a capitalized amount at death. This approach starts by listing the surviving family's sources of income, then comparing them with their expenses to determine if a shortfall exists. Their expenses to determine if a shortfall exists. 1.3.1 Income earned by survivors. Income earned by the surviving family could take the form of employment income, pension or investment income, or government benefits. 1.3.2 Ongoing expenses. The next step involves determining what the family's ongoing expenses are going to be after the death of the life insured. It is important to consider that certain expenses may black small square increase, e.g., childcare. Black small square decrease, e.g., food, clothing. Black small square be unaffected, e.g., home heating. Black small square be eliminated entirely, e.g., the life insured's golf membership, or mortgage payments if the mortgage is to be paid off with insurance monies. One 1.3.3 Income shortfall. If the income is less than the expenses, then an income shortfall exists, calculated as follows. Income shortfall equals expenses income. 11.3.3.1 Capitalization of income shortfall. The next step is to determine the amount of capital that would be needed at death to fund this shortfall in income. There are two approaches that can be used. If the intent is to preserve the capital, i.e., the capital retention method, then capitalization of shortfall equals annual shortfall divided by investment return. Ideally, the investment return used in this formula should be the after-tax inflation-adjusted rate of return. Calculated as $2,093,333 equals $2,983/month times 12 months, divided by 1.71%. A more practical approach for those needs that have a limited duration is to simply multiply the annual shortfall by the number of years the shortfall is expected. This is sometimes called a capital drawdown method. Any other ongoing expenses, such as support obligations to a previous family, could be handled in a similar manner. 1.3 for capital needs analysis. The next step is to identify all of the other lump sum needs that may arise as a result of death, to ensure that the estate has enough liquidity to meet these needs. 1.3.4.1 Final expenses. Final expenses refer to the cost of providing burial, cremation, funeral, or remembrance services. These expenses are generally payable a short time after death. The deemed disposition of capital assets upon death, and the deregistration of registered assets, unless a rollover is available, can result in a significant tax liability for the year of death. If the estate does not have sufficient liquidity to pay this tax bill, the executor, liquidator, in Quebec, may be forced to sell estate assets to provide the necessary funds. 1.3.4.3 Debt elimination. A common objective in a life insurance needs analysis is to ensure that the estate has sufficient liquidity to pay off all debts owing at the time of death. 1.3.4.4 For estate expenses. There are many expenses that could be incurred by an estate, such as black small square probate fees, which can be as high as 1.5% of estate assets, depending on the jurisdiction, black small square compensation for the executor or estate trustee, often in the order of 1 to 3% of estate assets, black small square legal fees, dependent upon the estate's needs, black small square asset management fees, particularly if the estate consists of a large investment portfolio, black small square property maintenance fees, if the estate includes real estate. Whether these are incurred as a one-time expense or on an ongoing basis, the estate will need sufficient cash to pay these amounts. 1.3.4.5 Emergency Fund. A common rule of thumb is that a family should have sufficient liquid assets in an emergency fund to cover 3 to 6 months of regular expenses, although many families fall far short of this goal. Even if the life insured has managed to accumulate such an emergency fund, it can be easily consumed upon death by final expenses, income taxes, or other estate expenses, which could leave the surviving family without this safety net. 1.3.4.6 Education Fund. The capitalized value of anticipated education expenses is often included in the life insurance needs analysis. 1.3.4.7 Estate equalization. Most parents with multiple children try to treat them equally or fairly, and this treatment continues even at death. However, sometimes the assets to be shared among the children do not lend themselves to equal division. If this is the case, insurance can be used to help equalize the distribution, at least from a monetary standpoint. 11.3.4.8 Charitable bequests and legacies. The capital needs analysis could include many other amounts, reflecting the unique situation and desires of the life insured. Often the life insured wants to provide for a charitable bequest upon death, either as a tax strategy or purely for philanthropic reasons. He might also want to provide a legacy, to set up a scholarship fund at his alma mater, or a lump sum to a child as down payment for a home. 11.3.4.9 Total capital needs. Once all of the capital needs have been identified, including the capitalized income shortfall, a total must be calculated. One dot 3.4.10 Assets available upon death. The next step is to identify all of the assets that would be available upon death to meet estate needs. This should only include those assets that are already in the form of cash or cash equivalents, or that the family is willing to sell to meet those estate needs. Becky is the beneficiary of Derek's Registered Retirement Savings Plan, RRSP, and his Defined Contribution Pension Plan, DCPP, and he believes they should be preserved for her own retirement. She will continue to live in the house, and the cottage is to be held in trust for their children. Presumably she will keep his newer car and sell her van. This leaves a much smaller asset base of $402,750, as summarized in the following table. One dot 3.4.11 Existing insurance. A summary should also be made of existing insurance, its term, premiums, renewability and convertibility, and for permanent insurance, its cash surrender value and ACB. The last step is to determine the shortfall in capital, which is calculated as capital shortfall equals total capital needs at death available assets existing life insurance. This shortfall represents the amount of additional insurance that should be acquired. It is normally rounded up to the nearest $10,000 or $50,000 amount. 11 Point for bringing it all together. Now that most of the number crunching is done, the life agent should be in a good position to determine if life insurance is needed, and to evaluate options that might be suitable for the client. However, a few more factors are worthy of attention before a recommendation is made. 1.4.1 Duration of risk. One important consideration is the duration of each of the capital needs, because this helps determine whether permanent or term insurance is required, and if it is the latter, the duration of that term. Among cases where the capital needs may be suited to term insurance, black small square need to pay off the mortgage with the insurance, only for the duration of the mortgage, usually 25 years or less. Black small square children's needs when most will eventually be financially independent, say within 20 or 25 years. Black small square need to replace employment income, usually extends only until retirement age, around age 55 to age 65. Examples of capital needs more suited to permanent insurance include black small square special needs children who may never outgrow their need for financial support. Black small square tax liability that only arises upon death, may not be realized for 30, 40 or even 50 years into the future, and it may also increase by that time. 1.4.2 Investment needs. If the client has maxed out his RRSP and TFSAs, and is looking for additional tax deferral opportunities, or an opportunity to transfer wealth to the next generation, then a whole life or universal life insurance policy may be a reasonable option. Case study: Derek and Becky are not maximizing their RRSPs, and they are only making contributions to their TFSAs in years when Derek has a bonus. Their only current investment program involves their rests for the children. As a result, they do not appear to need additional investment opportunities. 1.4.3 Cash flow versus premiums. Sometimes a trade-off will be needed between the ideal type or amount of insurance and the cash flow available to pay the premiums. If cash flow is limited, it is unlikely that the client will be able to afford the premiums required for permanent insurance at this time. However, if income is expected to increase in the future, the client may want to ensure that his term insurance includes a conversion option, which will allow him to convert to permanent coverage at a later date. If cash flow is generally adequate but fluctuates from time to time, a universal life policy that allows the policyholder to adjust premiums to some degree may be a good option. If the rest of the family does not have sufficient life insurance coverage, there may be an opportunity to cover them under the same policy. For example, black small square sum where all of the insurance could be done on a joint first to die or joint last to die basis on both spouses. Black small square the spouse and or children could be covered under a family life rider. Once the life agent has compiled all of this qualitative and quantitative information, he should be ready to assess various life insurance options and develop a recommendation. 1.5.1 Type of coverage. The first step is to determine the life or lives insured, the type of coverage, term, whole life or UL, and for term insurance, the appropriate term. 1.5.2 Death benefits. If several types of policies are recommended, the next step is to determine the benefit for each policy. 1.5.3 Premiums. Once the amounts and types of insurance have been identified, it is time to provide premium quotes on the recommended coverage. One 1.5.3 Premiums. Once the amounts and types of insurance have been identified, it is time to provide premium quotes on the recommended coverage. So should Derek use renewable 10-year term, T10, 20-year term, T20, or a combination of both to cover these term needs? Performing a cumulative cost analysis can help here, as shown in the following table. At this point it is necessary to compare $560,000 of T10 option A or T20 option B, renewable, dropping to $380,000 of coverage upon renewal, when his needs will have dropped. Remember, the premiums upon renewal will have already been set when he buys the policy. The cumulative cost analysis is provided below. Clearly, if only one policy is to be used, the T20 policy, option B, works out better than the T10 policy, option A, in the long run, with a cumulative cost of $67,680 over 20 years, compared to $105,624 for the T10 policy. However, notice the cumulative costs for each policy after the first 10 years, before the coverage drops to $380,000. At 10 years, the T10 policy is the clear winner, with a cumulative cost to date of $22,176, compared to $40,320 for the T20 policy. This reversal suggests that a combination of policies may be in Derek's best interests. At this point, a cumulative cost comparison is useful between black small square using a T20 policy for the entire $560,000, dropping to $380,000 after 10 years, option B as shown in the table above, and black small square using a combination of a T10 policy for the shorter term needs of $180,000, along with a T20 policy of $380,000 to cover the longer term needs, option C, shown below. The cumulative cost of this combination of policies over 20 years is only $61,850, compared to the $69,120 over 20 years for a single T20 policy, or a savings of about 10%. So given that Derek has two very distinct coverage periods, example, 10 years and 20 years, and is certain that some of his insurance needs are short-term only, then a combination of T10 and T20 policies will be more cost-effective in the long run. However, if he feels that his insurance needs may remain the same or even increase in the future, he may want to consider covering the entire amount with a single T20 policy. Note that while spreadsheets help illustrate the point, the cumulative cost comparisons can usually be done very simply using a calculator, as follows. Cumulative cost of 20 years equals $7,128 plus $69,120 equals $61,848. Replace Derek's existing $250,000 policy. Derek has an existing $250,000 term, 10 policy that is due to renew in 2 years. He was shocked to realize how much the premiums will increase upon renewal, from $250 per year to $1,125 per year. Derek heard that it is often cheaper to shop for a new policy, rather than renew the old one, so he asked his agent to determine the cost of replacing his old policy. The results are provided in the table below, which shows that Derek would be better off keeping his existing policy. The reason the results were disappointing for Derek was that he became a smoker after the original policy was issued. The old policy will remain valid, even though Derek is now a smoker. This is one of the reasons premiums jump so much upon renewal, because the life insured may no longer be in the fine health he was when the policy was first issued. Insurance for Becky and the children. Derek wants to obtain $150,000 of life insurance coverage on Becky's life, and $10,000 on each of the children. This can be accomplished in one of two ways. Black Small Square buying a standalone $150,000 term, 10 insurance policy on Becky, with a $10,000 child life rider, which would have a total monthly premium of $23.54. Black Small Square adding a family life rider to his whole life insurance policy, with $150,000 of term, 10 coverage on Becky and $10,000 each on the children, which would have a total monthly premium of $19.04. The standalone policy is more expensive because it has a separate policy administration fee. This fee is not charged when the coverage is added as a rider to Derek's whole life policy. Total costs. The total monthly cost of the recommended additional insurance is $956, as shown below. 1.5 point for beneficiaries. The agent may offer a recommendation on who should be named as beneficiary of the policy, based on his understanding of the client's unique situation and objectives. 1.5. For 1 primary and contingent. The applicant is required to specify one or more primary beneficiaries on the insurance application. Primary beneficiaries will receive the death benefit as long as they survive the life insured. Some examples include Black Small Square. If the funds are to be used to pay income taxes due upon death, the estate may be an appropriate beneficiary. Black Small Square. If the funds are to be used to provide a replacement source of income to the surviving family, then the spouse may be an appropriate beneficiary. Black Small Square. If the funds are to be used to support minor children, then a trustee should be named to manage the funds until the children reach the age of majority. Note that it is possible to name more than one primary beneficiary. If multiple primary beneficiaries are listed without additional instructions, then the death benefit will be divided equally among them. However, it is also possible to allocate different amounts to each beneficiary. Case study, with his $180,000. 1.5. For 2 revocable or irrevocable. In most Canadian jurisdictions, beneficiary designations are automatically revocable, unless the application specifies otherwise. In Quebec, however, if the policyholder designates his spouse as the beneficiary, it is automatically revocable, unless the policyholder specifies that it is revocable when he first designates the spouse as his beneficiary. There are only a few situations where the agent might recommend an irrevocable beneficiary designation, such as when black small square it is a requirement of a spousal or child support court order. Black small square there is a need to protect the insurance proceeds from creditors. Black small square it is being used to implement a tax strategy in connection with charitable giving. 11.5.4.3 Probate implications. Note that if the estate is named the beneficiary or if the estate becomes the beneficiary because the specified beneficiaries did not survive the life insured, then the death benefit will be subject to probate. In jurisdictions with high probate fees, it is usually desirable to name someone other than the estate as the beneficiary, but only if this is practical. If the proceeds are to be used to pay income taxes or other amounts payable by the estate, then the estate may still be the appropriate beneficiary, despite the probate fees that will result. Remember that the highest probate fees are still only in the order of 1.5%. Therefore, the desire to avoid probate should not be allowed to overtake good planning. Note also that when an estate is subject to probate, the contents of the estate and the terms of the will become public knowledge. Therefore, naming the estate as the beneficiary of an insurance policy means that the death benefit becomes a matter of public record. This increases the chance that someone might contest the distribution of the death benefit to its intended beneficiary. 1.5.5 Highlighting important clauses. When reviewing a new policy, the life agent should ensure that the policyholder is aware of and understands certain key provisions. These are covered in more detail in the module Ethics and Professional Practice. 11.5.5.1 Exclusions. If the policy was issued with a specific exclusion, the agent should ensure that the policyholder understands that if death occurs and is subject to that exclusion, the death benefit will not be paid. The life insured must then make a choice: either avoid partaking in the excluded activity, or accept the fact that the death benefit will not be paid if that activity results in death. Anne-Marie is an avid photographer and frequent traveler. When the insurance company inquired about her travels, she had disclosed that her most recent places of travel included Ethiopia, India, and South Africa. The policy was issued with an exclusion for death while traveling to Ethiopia, because of the perceived high incidence of disease and conflict at that time. The death benefit will be paid as long as her death does not occur in Ethiopia, and cannot be linked to an illness acquired from her travels there. Suicide. All policies have a 2-year exclusion period for deaths that occur as a result of suicide. This means that if the life insured dies by suicide within the first 2 years after the policy is issued or reinstated, the death benefit will not be paid. 11.5.5.2 Incontestability. For the first 2 years of a life insurance contract, the insurance company can reevaluate its underwriting of the policy. If it discovers that a material mistake was made in the application for coverage, the insurance company has the option of adjusting the premiums, adding exclusions, or voiding the policy. Thus, the policy is said to be contestable during the first 2 years. Reinstated policies are also contestable for the first 2 years following reinstatement. Once this contestability period has expired, the policy is said to be incontestable. This means that the insurance company cannot cancel the policy for any reason other than missed premiums or fraudulent misrepresentation. 11.5.5.3 Grace period. All policies provide a grace period for premium payments, usually 30 or 31 days after the date the premium is due. As long as the policy premium is received by the insurance company within the grace period, the policy will remain in force. However, if payment is still outstanding after expiry of the grace period, and the policy is not a permanent policy with an automatic premium loan feature, then the policy will lapse and coverage will no longer be in force. If the life insured dies during that grace period, the death benefit will still be paid, but it will be reduced by the amount of the outstanding premium. The COVID-19 pandemic resulted in significant job loss throughout Canada, and some policyholders were finding it impossible to pay their premiums. Many insurers responded empathetically by extending their grace periods to as long as 90 days, and providing the option to spread missed payments out over a year or more to ensure that policyholders did not lose their coverage as a result of the pandemic. 11.5.5. For reinstatement. If the policyholder does allow the policy to lapse, most life insurance contracts allow him to reinstate that policy within 2 years of that lapse, as long as he can provide proof of insurability and he pays all missed premiums, plus accrued interest. While reinstatement requires proof of insurability, there may still be an advantage in choosing reinstatement and paying the missed premiums, instead of just applying for a new policy. This is because the premiums on the reinstated policy will be based on the age of the life insured when the policy was first issued or last renewed, while premiums for a new policy would be based on his age at the time the new policy is issued. 11.5.5.5. Right of rescission. The agent should ensure that the policyholder understands his right of rescission once the policy is issued. This refers to the 10-day free look period, which gives the policyholder 10 days to review the policy after receipt of a new policy. During this time, the policyholder can choose to return it to the insurance company, and he will receive a full refund of all premiums paid. 11.5.5.6. Expiry. Term policies have an inherent expiry date, meaning that coverage will cease at the end of the term, unless the policy is renewable. 11.5.5.7. Surrender charges. For universal life insurance policies, the life agent should ensure that the policyholder understands any surrender charges that may be applied if the policy is cancelled or a partial withdrawal is made. Usually these surrender charges only apply during the early years of the universal life policies. 11.6. Using illustrations. Illustrations are commonly used to help the client understand the recommended policy, and they are often appended to the life insurance application so that the insurance company's underwriters have a clear picture of the coverage being applied for. In the case of a term policy, the illustration just shows the premiums payable and the death benefit in each policy year. For permanent insurance policies, the illustrations are more complex, in that they also include projections of future policy dividends, mortality deductions, investment account values, and cash surrender values for each policy year. However, these projections are only intended to demonstrate how the policy works, and are not a prediction of guaranteed or expected performance. Participating whole life and universal life policy outcomes are very sensitive to even small changes in investment performance, particularly over the long life of these policies. To highlight this sensitivity, most policy illustrations now include projections for at least 2 investment return scenarios. Agents must ensure that policyholders understand that the projections are not predictions of future performance. In fact, the policyholder is typically required to sign the illustration, acknowledging that he understands the limitations of the illustration. In addition to the official policy illustrations generated by the insurance company's software, agents may find it useful to develop their own simple spreadsheets to compare products or insurance options, such as those provided earlier in the case study above. Chapter 12. Ongoing Service. Competency component Black small square provide customer service during the validity period of coverage. Competency subcomponents Black small square validate the appropriateness of contract amendment, renewal and termination applications in regards to the client's situation. Black small square inform the claimant of the claims process. Life Insurance Chapter 12 Ongoing Service 262.